There we go. Very welcome everyone welcome back to the Microstructure Exchange. We're very excited to be back after the Christmas and job market break, and to have Joel Hasbrouck here for the first talk for the season. And we're trying a new format here, as everyone can tell. We have switched from the webinar to the Zoom meeting. And we hope this will give a bit of a boost to the interaction in the seminars. So everyone is very welcome to have their cameras on. If you want to, just be aware that we are recording this, and it will be posted to the website afterwards. The format, however, is going to be pretty much the same. We have asked Joel to prepare a 45-minute talk, including a couple of question breaks. And then afterwards, there will be more time for discussion, 15 minutes to start with, but Joel has promised to stay on for as long as there are questions within reasonable bounds, I guess. And the difference then is that when there are question breaks, then you can still type in the chat your question, and then I will read the questions. But alternatively, you can raise your hand use the Zoom function for raising hand, and then I will give you the word, and you can ask your questions live. So it's a bit of an experiment today. We hope it will work out so we can keep this format. I think that is all I have to say before I hand the screen over to Joel. So Joel, please you can share your screen, and then we're good to go.
Okay, are we good? Bjorn, can you see the screen?
Excellent, yeah.
Good, wonderful. All right, I'm going to be speaking today about the foreign exchange market. My co-author on this paper, Richard Levich, has been studying foreign exchange markets really since longer than I've been studying microstructure. So he is not a regular fixture at microstructure seminars or workshops, but he has been a remarkable guide to what is a market that is in many respects kind of unusual. Now, it's an unfunded study. The data do come from CLS Bank, about which I'll speak more a little later. They're commercially available, but not in the detail that we have the data here. Also, while this work was in process, I did some executive education for a firm that does FX trading. Now, to get to the quick overview here, the elevator pitch, this is a paper about OTC markets modeled as networks. And in the network paradigm, we sometimes measure an agent's importance in the network by their centrality. And that can determine, or at least be associated with, their trading costs. So in these OTC markets, particularly from the network perspective, there is a question, which is, how does centrality affect the prices that intermediaries give to their customers? Do they extract a premium, or because of competition, do they actually offer a discount? Most of the empirical results come from smaller markets, US markets, over-the-counter markets. And Richard and I are examining the foreign exchange market, which is much, much larger. We find a premium. Now, the economic background for all of this starts with a distinction between over-the-counter and exchange markets. The over-the-counter markets, like the FX market, are decentralized. also characterizing bonds, swaps, and similar. Also known as dealer or quote-driven two-tier markets, depending on the context. And the contrast is with the equities markets, the centralized exchange markets. Now, most generalizations we can make about these two kinds of markets, they're not, the closer you look, correct. And this is even true of this generalization. It's not an either or kind of thing. An interesting recent paper by Craig Holden and co-authors looks at, in the Chinese interbank market, a parallel centralized and decentralized market. But these markets, one of their key features seems to be there is a segmentation. The dealer to customer transactions differ from the dealer to dealer or interdealer trade. And over the years, we've had many ways of looking at these markets, but probably the dominant paradigm right now dates to Duffy, Garlino, and Pedersen from around 2005, based on random search. And here, the search intensity in their model is inversely related to the dealer's bid-ask spreads. Now, in applying this model to the OTC markets that we observe, it becomes apparent that many markets depart somewhat from the random search idea. So if two trading counterparties, usually their relationships persist. It's not random from one interaction to the next. And these identities and these relationships tend to be sticky. There's a reason for this. It's costly to establish a trading relationship and keep it going. So if we have search, and I think we do, it's probably a little bit more realistic to think of it as being directed search. And with this persistent directed search, we have the beginnings of what we might think of as a network. And one of the regularities in looking at these markets is that they exhibit a classic sort of core periphery kind of structure. We have a few highly connected central or core participants. Think of those as the major dealers. And the peripheral agents, the customers, are going to trade only with one, two, a small number of core participants. Now, a network, of course, will be defined by its nodes, here the trading agents, and the edges, the links. There are a number of ways of imputing links. In our work with these data, we will impute a link if the two nodes do at least one trade over a sample month. Now, in a trading network, you can construct links that are directed, that indicate the flow of the payment or the security. Our edges are not directed, they're undirected. And in most of our base case results, the edges are going to be unweighted. I'll talk some about the alternative weighting schemes. They give pretty much the same results. So to show one of these, I constructed a subgraph of the Euro-US dollar network for April 2016. Now, this is a subgraph, so the full network has about 5,700 nodes. And if I were to put that picture up, it would be a very dense blur. So to make the present point, I just picked 10 remote nodes at random and then looked at their immediate neighbors and drew all of the connections. Here you see, even in the subgraph, this core periphery structure emerging. So the numbered nodes here are the peripheral customers, but then their neighbors, their immediate neighbors, form a highly interconnected core. These are the dealers. To measure the importance of a node, we usually rely on centrality. The simplest measure is degree centrality. So how many connections do we have? In this picture, most of those peripheral nodes have only 1 degree, but 2, 3, and 9 have 2 degrees. For the other members in the core, it's mostly greater than 8. And although I'm going to do mostly unweighted degree centrality, sometimes I'm going to show you some results where it is weighted by trading volume. And the interesting thing about that is that weighted degree centrality is proportional to market share, which is arguably a much simpler construct and certainly more intuitive. Now, the relating trading costs and centrality, we encounter several themes in the literature. So certainly one is central agents will have lower costs of intermediation. Others, Nekhlyadov and others have made this point. And the idea is if you're connected to many different other nodes, then you have a larger range of counterparties to intermediate to or lay off positions against. And in Nekhlyadov's model, there is exogenous variation in the dealer's search intensities. So this gives rise to lower costs of intermediation. And due to competition, these efficiencies get passed along in the form of lower costs to the customers. Just like in normal IO, most costs of production would get passed on in equilibrium. So in Nekhlyadov's view, centrality should be a centrality discount. But often in OTC markets, the centrality can be associated with some kind of extra or differentiated service. Lee and Chertoff suggest speed. And if there are customers who prefer fast intermediation, the central dealers will specialize in providing that speed, which sounds reasonable. And to cover the costs of that speed provision, they will charge higher prices, a centrality premium. A third idea relates centrality to bargaining power. And what we think of as the first order effect is that a central dealer may be more dominant, they should have more bargaining power, and there should be a centrality premium. But it doesn't have to go this way. So Hollifield, Nekhlyadov, and Spat also suggest that these fast central dealers may attract more sophisticated customers. And in their view, it's the customers that might have the higher bargaining power, and that might lead to a centrality discount. So we have economic themes here that suggest it might go both either way. The empirical evidence is mixed. So Lee and Chertoff look at US municipal bonds, premium. DiMaggio, Kermani, and Song, corporate bonds, also a premium. Gabrielli and George, overnight lending, also a centrality premium. But Hollifield, Nekhlyadov, and Spat in US securitizations find a discount. Juilliard and co-authors analyzing repos and reverse repos also find mixed evidence. So whether you find a premium or discount, the evidence here is mixed, but most of the evidence is coming from credit markets that are smaller. The foreign exchange market, which is what Richard and I are looking at, is much, much larger. Whereas those credit markets might have turnover of $1 billion a day, in the FX market, it's trillions. By way of pre-existing studies, we have one recent study by Bjorn and Albert, which finds a weak evidence for a centrality premium. Their paper looks at one currency pair, 8 dealers, a 3-week sample, and it is a period of time when a lot of information was hitting the Swiss franc market. And so their results suggestive of a premium, but not conclusive. In this paper, Richard and I provide, I think, more conclusive evidence of a premium and also suggest another cost that might account for it. This would be a good place for FX type or network type questions. So I'll take a pause here and see if any have come up.
Yes, so we don't have any questions in the chat yet. And so
Okay.
if anyone has a question, please use the raise hand function. In the meantime, I'll ask a question, Joel. As you can see from this slide, I'm sympathetic to the network approach. But the skeptical question would, of course, be that what you find in this network is that you find a core of some trading firms that trade very heavily, and then a periphery with traders that mostly trade with one of those in the core, and that is very similar to identifying the dealers and the clients, as you said. So
yes,
what do you think is the main benefit here of the network approach relative to just grouping them by trading volume?
But okay, first of all, we are going to be looking at a very large number of participants, and the centrality evidence that we provide is going to apply not just to pairings that are highly likely to be customer to dealer, that is small to large, but also between customers and slightly more central customers, and dealers and slightly less central dealers. So it's the gradation here that a dealer versus customer dichotomy is pretty, it's pretty rigid, it's pretty extreme. As a practical matter, we think it is much blurrier now than it ever has been before. So the distinction between customer and dealer is perhaps less meaningful, but also we're going to find centrality premia where there is, we think, variation in centrality that does not map cleanly to the customer-dealer distinction.
Great. So Sophie Moina has a question. She didn't find the raise hand function. It should be under reactions. But Sophie, feel free to unmute yourself and ask your question live.
Okay, thank you very much. Joel, I have a naive question on the FX market. Is it a non-anonymous market? And I also have a comment on the papers that you quote. There is also this argument that central dealers would learn by trading. This is an argument that is made by Norman and co-authors in one of his papers.
Okay, your first article, is this an anonymous market? The market has many mechanisms, some of which are anonymous, some of which are not. For example, many in the telephone market, in the voice broker market, you may not know your ultimate counterparty, but on in an interbank limit order market, you probably do know your counterparty. Your other point about Kermani, that one I'd like to take offline if possible later.
Okay.
All right.
So
do we have others?
Yes, we have another question.
Okay.
Andre just corrected me that the raise hand function is in the participants submenu. There you should be able to find it. So we have a question from Michael Goldstein, and he typed it in the chat. So I'll read it out. Joel, the FX market is larger than corporate bonds, but I recall Carol Osler telling me like 90% of it is inter-dealer trades. Also, those statistics are worldwide versus just a US country.
Yes.
What would just the customer buy and sell FX volume be? And what does it mean for the implications of your paper if 90% of the trades are inter-dealer for markets where inter-dealer is closer to 25%?
Okay. Traditionally, the 90% inter-dealer trade, that would have been a very representative figure. If you look, though, in recent BIS statistics, it's the dealer-to-dealer trade compared to, say, customer-to-dealer, or nowadays even customer-to-customer. It's much lower. The most recent BIS figures would have inter-dealer trade maybe about, well, I'll be showing you some statistics varying on that, but nowadays, my guess is it's probably closer to a third.
Okay, so I don't see more questions at the moment.
Okay.
So let's continue, Joel.
Now, I'm now going to get into the FX market in a little bit more detail, in particular, our settlement data. The paper I'm talking about today is part of a research agenda. There's a companion paper, a precursor paper, that has many of the descriptive overview of our settlement data. So I would say, like most dealer markets, the nature of the FX market has changed in the last 10 or 15 years. So we have a traditional view of our dealer markets that has a sharp segmentation between customers and dealers. And in this traditional view, the inter-dealer market is very dominant. It dominates in two respects: price discovery and also liquidity. And the segmentation is very sharp to the point where the customers have no direct access to the inter-dealer market. The world has changed. In particular, this segmentation has become a lot more porous. So we have these multilateral trading systems, a proliferation of markets with RFQ, request for quote, protocols. And this gives customers access to more than one or two dealers, often many. Also, there's been a proliferation of prime brokerage. So under the sponsorship of a direct participant, large customers can often get direct access to the interdealer markets. And this has led to, of course, algorithmic trading as it has in other markets. Also, as we've seen in equities markets, the classic market makers have been augmented, displaced by what are called in the FX terminologies, so non-bank liquidity providers, proprietary trading firms. So if I had to summarize the consensus now, most participants would still agree that if they want to know where the real market price is, they'd go to the interdealer quotes. But for actual trading, there are many alternatives other than going right to one of these central dealers. Our data come from the CLS bank, and CLS nowadays, it just stands for, it's nothing, CLS, but originally it was continuous linked settlement. And the FX market has always been a global market, multiple time zones, multiple countries, different regulatory and legal structures. And with all this non-overlap, we have settlement risk. And in the early part of the millennium, the banks, under some pressure from regulators, organized CLS to manage this risk. Now, the spot settlements here for CLS are restricted to 18 major currencies, so they don't do all of the some 200 odd currencies used worldwide. The members, there are 70 settlement members. These are mostly the players you might think of. They are the larger banks. But we also see in our data third-party settlement members. And a third-party settlement arrangement is something like a prime brokerage arrangement in that you are doing your own settlements, but you are doing it with the backstop of a full settlement member. Now, it's these third-party settlement members that are giving us a much broader perspective on the market. This is not just an interdealer arrangement. These comprise smaller banks, a lot of principal trading firms, and also corporations. We can't identify who they are, but 25,000 of them, and talking to the CLS people, we have a pretty good sense of what their range is. So what does CLS Bank do? Well, first look at a CLS, at a trade without CLS. That is with bilateral settlement. So it's an exchange of euros for dollars. Citi is receiving the euros and paying the dollars. Now, first thing that happens is there is a trade. Maybe the trade takes place on EBS, which is an institutional limit order market. Morgan and Citi put in their orders. If there's a match, EBS sends them a report. But that does not actually settle the trade. It doesn't actually transfer the currencies. So the first thing that has to happen is that there's going to be a mutual confirmation. Was it for €1 million? No, it was 10 million euros. Or no, the price wasn't 1.1, it was 1.109. So all of those details get settled out, and then the actual transfers can take place on an interbank transfer system for cash, typically SWIFT. How does it work with CLS? Well, the beginnings start the same. There's an order, there's a report, but now CLS steps in the middle. But it's not like a clearinghouse. So Morgan and Citi send instructions to CLS. If CLS says, okay, you guys match, Morgan and Citi both pay in. Once they've both paid in, CLS pays out. But if one side doesn't pay in, the other side gets their pay in refunded. So CLS does not guarantee performance. It is sometimes called a guaranteed refund system. Now, the instructions here are what are going to give us our timestamp right there. So CLS gets settlement instructions from the counterparties. They authenticate, and our sample consists of all settlements in 2010, 2013, 2016, the Aprils, and these months were selected to coincide with BIS surveys, so we could do a certain amount of consistency checking. Now, in these data, we know what the currencies paid and received are. We know the counterparty identifiers. They're anonymized, so we don't know ultimately who they map to, but we can track their performance within a month. We also know to the millisecond when the settlement instructions were received. Those data we know exactly. We think that most of these settlements correspond to trades, but we don't know exactly. We don't know the exact time of the trade. And the reason is, in between the trade that takes place up here and the submission of the instructions, there might be a small delay. We also do not know the execution platform. My example was an interdealer limit order book, but it might be RFQ, might be a multilateral trading system, might be a voice broker. We don't know. We also don't know if it's maker or taker. So a lot of the characteristics here of the trade, we know very precisely, but some things that we would take for granted in a set of, say, equities data, we don't know. So how much of the market are we seeing here in CLS? The BIS estimates of turnover are generally considered the most authoritative. Most FX microstructure concentrates on studies of either EBS or the Reuters FX matching system. They are the interdealer limit order markets. Between them, they have 13% of the market. Each one, and EBS by itself is about 6%. CLS, in contrast, is much larger. We're up to 37%, nowhere near 100%, but certainly a much bigger slice of the market than we were getting from just looking at the interdealer limit order books. Now, we do need an alternative source of prices, though. And for those, we're going to be getting our data from Olsen. Olsen's streaming, Olsen collects streaming bids and asks from banks, multilateral trading platforms. Our sample from Olsen is at the 10-second frequency. These are not market-wide best bids and offer. As a matter of fact, they may be not accessible by anyone. They might simply be indicative, and they won't be visible to everyone in the market. So these are generally considered representative quotes, but they aren't anywhere nearly as authoritative or firm or accessible as the NBBOs in an equities market. Do they match up with our clearing settlement data? About up to 70% of our settlements can be matched pretty closely to the Olsen bid and ask quotes from the prior 10 seconds. If we go to the prior 60 seconds, we can get that match rate up to around 90%. But it's not perfect. And I'll come back to this later when we talk about the timing of our profit imputations. And this too, this would be a good point to pause and take some more FX questions here.
Great, thanks, Joel. Cameron has a question.
Hey, Joel. So the first thing I had was mostly just a data question. So do you observe membership status? So whether or not a trader is a third-party clearing member or a central clearing member?
We do not.
Okay.
They are, of course, going to be related to size. If it's a participant that does 20,000 settlements, it's likely they're a settlement member. If they do 2 or 3, it's much more likely they are a third-party settlement member, but these are not identified.
Okay. I also had a follow-up question, which is, I guess, not really a follow-up question, but so when you're when Olsen is like, they're basically going in through the RFQ system, right? And they're just asking everybody every 10 seconds what they're quoting. So presumably,
not necessarily. It's my understanding that many trading firms will stream bids and asks. Now, these will be streamed on multi-bank trading platforms, maybe single bank trading platforms, and not all the customers get the same streams, but they are not by request only. That is, they are continuous.
Cool, that answers my question. Thank you very much.
Okay.
Then we have a question from Albert.
Hi, Joel. Interesting stuff. Just a quick question. You made it sound like the time between the reporting of settlement and or settlement to CLS and the trade wasn't zero necessarily, but it was small. But is there any strategic considerations if I do a large, as a dealer, do a large trade for a client and the client whispers into my ear, I don't want this to be known in the market, or I have reasons to not have this, the size of this trade known to anybody.
Okay.
Is that maybe delaying settlement, or is it, does nobody see CLS, so do dealers don't worry about this?
Well, certainly if you've done a large trade, even if you don't know the identities, you would often want to conceal the existence of that trade. All right, this is certainly true in credit markets, and it's probably true in FX markets as well. Now, can you delay your submission to CLS? Sure. But a couple of points. One is, the longer you delay, the longer you are, you're running some settlement risk here. So in order to shut that risk down, you'd want to start the settlement procedure as soon as possible. Also, although CLS will know these data, the data are only available to subscribers in hourly aggregate form, and only with a 30-minute delay after the close of the hour. So at worst, your trade could not be known. It would be part of overall volume, but not for at least 30 minutes.
Thanks.
There's a question from Andreas.
Hi, Andreas.
Hey, Joel, how's it going? It's good to see you. So let me ask you, so this is more of a question for my own interest. It seems like settlement here happens real quick. Do you have any sense of how this generally works between the banks? Because, the settlement process, as we know from equities, is really complex. And here we have, banks that are in different parts of the world and without a central bank. So how does where's the custody and all that?
It is remarkable. And it is remarkably efficient. It does involve access. All right. So these CLS has arrangements with all the relevant central banks. And there is one, they have an access to an account outside of normal business hours. So this is a special arrangement, and it is a lot cleaner than the settlement, say, for equities or for swaps or anything that does not really have to transcend national boundaries. That said, I have simplified it somewhat, and there is a certain amount of netting that does go on. There is a clock, but it is, I would imagine, Andreas, you might be wondering, is this a messy process that could perhaps be improved by a blockchain? Maybe, but there is not a lot of fat in this system. There is not low-hanging fruit here like there might be, say, in an international equity settlement. If that was the question.
Sure.
Put it on the chain, man.
Very good.
Okay.
Joel, there are a couple of clarification questions in the chat, and after that we will have to move on.
Okay.
Where Kurt Riedel is asking, you're doing only spot, correct?
Only spot. CLS also does forwards, but there's less forward volume.
Yeah, and some is not CLS currencies, but most is just not CLS cleared, question mark.
The stuff that's right. You can still use bilateral settlement, and that is used for many transactions.
Great. So then let's move on.
Okay. So I'm going to get quickly into our measurements and what we do. I first need to tell you something about the pricing conventions here. The foreign exchange market, the operant word is exchange. Two currencies are exchanged. The currencies are usually written with a fraction bar in between them. The euro US dollar market is written euro/US dollar, not USD/euro. So in this market, a price is going to be the number of units of the quote currency, the second currency, that's exchanged for a unit of the base currency. So if you see 1.2, that means 1.2 US dollars for each euro. Now, could you get a quote of euros for $1? Yes, but it would be a special kind of thing. A dealer would do it for you, but that's not the way the interdealer market, for example, is organized. And to measure profits or trading costs here, for each settlement, I'm going to identify a proximate benchmark price, M. I want you to think of this as the quote midpoint, either right before or right after the settlement. And then using this relative to this benchmark price, I can impute a profit, which is pi, and for the buyer of the base currency, they pay P, and if they could reverse the trade at the quote midpoint, they would receive M. Now, so as an example, if I buy a euro at $1.10 and my proximate midpoint is 1.11, I have an imputed profit of a penny per euro. Of course, across both sides of this exchange, these imputed profits are going to sum to zero. So we're only going to look at the profit to the buyer of the base currency. Also, in equity market transaction cost analysis, we're making a distinction between maker and taker. That, and then we compute effective and realized costs. For the takers, we don't observe that here. We don't know who's the maker, who's the taker. So instead, we're looking at the buyer of the base currency. Now, our bids and asks here are the Olsen streaming quotes. So for our base case results, we're going to look at the midpoint as of the end of the interval where the settlement instructions were first set. But we also look at the prior interval, several minutes post-settlement, so we investigate a range here. Our question here is, how does this imputed profit depend on the relative centralities of the buyer and seller? So if the buyer centrality is bigger than the seller centrality, if it's a centrality premium, we would expect the higher centrality counterparty to realize the profit. If it's a seller who is more central, we would expect the buyer of the base currency to be losing. That is, their profit would be, in effect, a loss. If it's a centrality discount, the ordering would go the other way around. Now, this argument here is based on an ordering of centrality. We don't really have, from any of the economic models, a functional form. So we want to be flexible here. So we're going to partition these settlement members into groups from low centrality to high centrality. Low centrality is 1, high centrality is 5. And we're going to look at trades between these groups. We're going to do this in a linear mixed effects model. And the centrality premia or discounts are going to be captured in these fixed effects right here, which are going to correspond to the expected profit to the buyer of the base currency, conditional on knowing that the buyer is in group I and the seller is in group J. So if I is bigger than J, the buyer is more central. And if that fixed effect is positive, we have a centrality premium. But also here, we would also expect there's going to be a symmetry. That is, if it is the seller who is more central, we would expect they would be the ones to realize the profits, imposing a loss on the buyers. Now, we're not going to impose this symmetry. I'll show you some evidence on it. But still, I'm also going to show you some averages, and that they are very useful for summarizing. We do impose a restriction that if there's a trade between two members of the same centrality group, neither one should have an advantage. And we do impose a restriction that that fixed effect is going to be 0. Our error specification takes into account that really within a currency and within time, we're going to have multiple settlements. And because they are all being benchmarked to the same, quote, midpoint, we do allow for correlation between the profits for these settlements, between these errors in these settlements. And before I get, but it's, other than that, it is a fairly standard mixed effects model. Before going on to the results, are there any questions about the econometric specification?
Okay, I think we can take one question,
yes.
Joel, and then probably move on. So
right.
I'll give that one to Daryl Duffy.
Hi, Daryl. Daryl, I think you're muted.
Okay, I managed that. Joel, thanks.
Yes.
Brilliant so far. You made
We'll
the
stop
symmetry
here.
assumption.
No, go on.
Yeah.
The symmetry assumption.
Mu I comma I equals 0. If you actually look at just the sample average, what does it look like?
All right.
When an I segment trades with an I segment firm,
yes.
Is it near 0?
Yes, it is. They are statistically different from 0 because we have a large we have large samples here, but they are fairly close to 0. They are not exactly 0 because in any time period, even a month, there is going to be some drift in the exchange rate that is going to tend to favor buyers or sellers. So it's close to 0, but not exactly.
Thanks. I appreciate that.
Now, when we form our centrality groups, I want to point out that this is still a very, activity here is still concentrated in the larger settlement members. So for reasons of preserving anonymity, we require a minimum of 5 settlement members or 5 members, either third party or full settlement members in each group. The largest or the group with the highest centrality has 44% of the volume. All right. So activity and also their unweighted degree centrality is over, on average, over 1,400. The fourth group has another 21%. This is for the Euro USD. And it's not until we get into the lower groups that the volume really drops off appreciably. The settlement flows between groups. So this is, as you would expect, mostly concentrated in the higher groups. So within the highest to highest group, we're up about 18%. Within, say, the fourth and fifth groups, that is all these trades, we're probably talking about maybe around 40% of the settlement volume. But notice that even in the lower settlement members, we still have direct trade between low degree members, groups 1 and also between groups 1 and 2. So the dichotomy here is not purely, it's not purely a dealer to customer kind of thing. There's also evidence of trade between low-ranked entities here. Now, these are this is really the key results. What do these fixed effects look like? So let's pick a number from this table, table 8. This number, the buyer centrality is 2, the seller centrality is 1. So the buyer is more central. We would expect them to have the advantage, and they have a slight trading profit here, a very small 0.06 basis points, but it is statistically significant. On the other side of the diagonal, this is when the seller is more central. Here, the seller is group 2 centrality, the buyer is group 1. Here, the seller has the advantage, and they are, this leads to, on average, a loss for the buyer. So looking at this overall picture here, the matrix is skew symmetric. So in the upper right triangle, where the sellers have the advantage, the numbers are all negative. In the lower triangular section, where the buyers have the advantage, here, with one exception, the number entries are all positive. So this is consistent with our intuition of a centrality premium that is directional depending on whether the buyer or seller has the higher centrality. Now, to summarize these effects, we average across the diagonal, flipping the sign on the upper triangle. And now, instead of talking about buyer versus seller, we can talk about the higher centrality player versus the lower centrality player. And this is in panel B of that table. I should say, these are averaged across buyers and sellers. For all currency pairs, these are pooled estimates. There is a pattern here of monotonicity, generally. So take, for example, somebody in the lowest centrality group. When they are trading with a group 2, group 2 does better. And the advantage, or how much group 1 loses, increases generally as the centrality of their counterparty increases. Or starting from group 5, if we move in this direction, group 5, their advantage declines as they start trading with counterparties whose centrality is more comparable to their own.
So Joel, we're approaching the full hour here, and
yes,
all
right,
try to conclude soon, and then we can continue the discussion.
I'm going to wind up. This, what I just showed you, is the basic result for the evidence of the centrality premium. We look at size, alternative benchmarks, estimates by currency pair, and these are refinements, and also the centrality premium result is very robust. Now, the last evidence I want to show you is on why does this premium exist. Is it bargaining power? Perhaps, but it might also be compensation for adverse selection. So traders, incoming traders, might not be independent. Orders might have a systematic component that affects the prices. So we don't have a maker-taker distinction in this market, but it might make sense to ask if relative centrality could be used in a similar way to sign the order flow. And we construct a signed order flow measure based on relative centrality of the two participants and look at how that is correlated with contemporaneous returns. So the returns here are negatively associated with this centrality signed order flow. This means that the central agents tend to be buying when the price is going down and selling when the price is going up. This is association, not causation, but it is consistent with liquidity provision. So to summarize, we would say the settlement market has many players and it does not map into the traditional customer and dealer pattern. But central agents in this market do achieve better terms of trade. Maybe it's bargaining power, but they also are exposed to adverse price movements consistent with liquidity provision. And I'll leave it at that. Happy to take further questions.
Yes, thank you, Joel. Very nice paper and presentation. So now, for anyone who wants to ask a question, please raise your hand if you have found the raise hand function. Otherwise, just type in the chat, perhaps. So there's a question from Peter Lerner.
Hi, Peter, you're muted.
Hi. Does it mean that CLS plays the role of market maker in this FX market, at least for 37% of the participants?
To call them a market maker would suggest that they have some kind of pricing power. They are not in that sense a market maker. They do not provide liquidity. They simply facilitate the clearing and settlement of trades that are engaged in by other market participants, including market makers. CLF itself, they would describe themselves as being a part of the plumbing, not a part of the liquidity provision directly.
Albert has the next question.
Yeah, Joel, I was triggered by that interesting twist you did at the end, where you signed based on centrality difference. And I wanted to connect that to a point that Björn raised earlier, just to maybe get a bit more bang for the buck, making your point, because it might be a crazy idea, but here is one way to partition the agent space, which is what some people just happen, the polar case here, some people just happen to trade with one person or one other agent all the time. You could throw these people into a bucket called clients, and then everybody else goes into dealers. Now you could do the exercise again that you did. And this, arguably is probably a client to dealer relationship. And if you then show that your right-hand side variable has additional explanatory power over and above this simple one, gives you maybe more traction to state what you stated right at the beginning. But it's not a dealer to client. It's basically every way you are on that scale matters for the price you get. I hope you get what I'm trying to say.
That is, yes, Albert, that's an excellent suggestion. And I would say consistent with this, CLS has been trying to monetize their data, and they have been releasing with these hourly aggregated data. Some of it has been classified, not on Centrality because they don't disclose identities, but they have been trying to identify groups of participants, so-called retail, corporates, non-financial proprietary traders. So there is pressure, at least in the aggregate data somehow, to identify these participants, which I think that is all we have is Centrality to work with. They obviously have more, and it's an excellent suggestion, and I think that's a direction that they are working in.
Thanks.
So Joel, connecting to this maker-taker distinction, you're relying on the Olsen quote midpoints for the fundamental value when calculating your return, but you don't do trade signing using something like the Lee-Reddy algorithm. What is the reason that you don't want to go mimic the equity market research in that way?
The main reason is, let me, I'm going to share my screen again to show you sort of Exhibit A from our earlier paper. So here's the euro US dollar on one day in April 2017. The dark line here is the Olsen midpoint. And you can see that, I think mainly due to timing errors, they don't line up. The settlements in the light gray do not line up very accurately with the Olsen quotes. For that reason, we don't have enough faith in the timing precision to be able to use the bids and asks to actually sign the trades.
I see.
So
Thanks.
can I ask if the reporting, because it looks like some of these just like kind of get reported in batches, right? Like some dealer will kind of close out like a suite of trades that they made.
Sure.
Do those vary by size? So do they delay like really big trades, or is it just kind of an even distribution?
We've looked at it. It tends to be pretty random. There are some currency pairs where it is a little bit more evident than others. We do try to filter these out, but this is what the data look like, unfiltered with all their imperfections. So the reason we're not using Lee and Reddy, I guess, is we're not sure of the relative sequencing.
Great. So everyone, please raise your hand if you have a question. We have more time to chat with Joel here. So I'll take another question if you don't mind, Joel. In the literature on two-tier markets, then we sometimes learn that the dealers, they have a pool of clients, and they are able to extract information from that pool.
Yes.
And then they bring this information when they trade with other dealers in the inter-dealer market.
Yes.
And so my question is basically, if do you think your evidence is inconsistent with that that way of seeing it, that the most central dealers are able to charge the highest markups to the periphery, whereas the literature I'm referring to would say that they might give lower markups to them because they're able to extract information from them?
Are they consistent? You know, broadly, I'd have to hesitate there, because we have looked, for example, in many OTC markets, we see evidence of intermediation chains. So particularly in the credit markets, in the bond markets, you'll see a position that gets passed from one dealer to another dealer, ultimately ending up connecting two customers. In the FX market, we don't really observe those intermediation chains. And it may be because we are only observing part of a dealer's activity. So to really be convincing about that learning hypothesis, I would like to see it in the individual dealers. We have looked at that. We have looked for evidence of inventory control. We don't find it. And it just may be it goes on, but there's too much noise in the data, or our observations are too fragmentary. So our evidence doesn't rule it out, but neither does it confirm it.
Interesting. Are there any other questions? Okay, so then I think we'll close here. Thanks a lot, Joel, for giving this paper at the Microstructure Exchange. Great to have you.
Thank you very much, Bjorn.
Thank you. Bye-bye, everyone.